Right now, the global economy is it's staring down the barrel of $82 a barrel oil. And, for a country like South Korea, which basically imports like every single drop of energy it uses to run its massive industrial sector, that should be an absolute economic death sentence.
Oh, yeah, completely.
Right. I mean, we're talking about billions of dollars just bleeding out of their economy just to, keep the lights on. Yet, if you look at the economic forecasts, they are sitting on this massive trade surplus. And the entire reason why, it's literally a tiny piece of silicon you can fit on the tip of your finger.
It's a profound paradox, really. I mean,
Yeah.
you have these heavy, physical, real-world commodities like crude oil threatening to just crush a national economy.
Yeah.
And it is being entirely counterbalanced by, microscopic architecture
Yeah.
that's powering artificial intelligence half a world away.
It's wild. Welcome to this deep dive. For you, the listener who wants to actually understand the invisible wires connecting our world without, getting buried in all the noise, we have a really fascinating mission today.
We really do.
Yeah, we are taking a stack of four seemingly unrelated sources and connecting the dots. We're going to look at an S&P global market report on corporate tech strategy, a Korean economic analysis on macroeconomics, a highly technical breakdown on retail options trading from Tasty Live, and finally, a super dense Federal Reserve paper on international capital flows.
Which, I mean, let's be honest, sounds like they belong in four completely different college courses.
They totally do. But by the end of this conversation, you will see exactly how the AI boom is completely reshuffling the memory chip hierarchy, how those chips are single-handedly saving South Korea's economy, how traders are placing these clever bets to capitalize on it, and then the massive twist.
The twist is my favorite part.
Right, how the very financial tools we use to invest in these trends might actually be destabilizing the whole global financial cycle.
Okay, let's unpack this. We got to start with the sheer scale of the semiconductor space right now, specifically memory chips.
Yeah, if you look at the raw data from KST Live,
Yeah.
the price action in memory stocks is just, it's historic. Oh, absolutely.
We are seeing companies like Micron having $20 to $40 daily price swings.
In a single day.
Right, in a single day. And SanDisk had this mind-boggling run from the $20 to $30 range all the way up to like $1,400. It's a genuine modern-day gold rush.
But what I found so fascinating in these sources is that the U.S. markets have become so frothy, so wildly volatile, that capital is aggressively hunting for alternatives. Investors want out of that specific madness.
Yeah, they're looking overseas.
Exactly. And they are landing squarely on South Korea, home to these memory giants like Samsung, which, by the way, recently crossed a $1 trillion market cap.
Which is staggering on its own.
Right, and SK Hynix. But it's not just a general interest in tech. There's this massive structural hierarchy shift happening between those two Korean giants, and it's driven by one very specific piece of technology.
You were talking about HBM, or high bandwidth memory? For anyone wondering why SK Hynix and Samsung are the center of the financial universe right now, I mean, this is the answer. HBM is the critical, basically non-negotiable component required for training large language models.
Like ChatGPT.
Exactly.
Yeah.
The technology that makes ChatGPT or, Google's Gemini possible, it simply does not function without it.
Wow.
And according to the S&P Global Market Report we reviewed, the demand for HBM is so intense that SK Hynix is actually projected to dethrone Samsung as the leading DRAM supplier by revenue in 2025.
Which is wild to think about, considering Samsung has been the undisputed king of memory for, well, as long as I've been following tech.
Pretty much.
But the numbers from S&P Global, they're just stark. They project SK Hynix to hit $49.6 billion in DRAM revenue next year.
Right.
Which edges out Samsung's $46.4 billion.
And the underlying mechanism for that, that changing of the guard, is purely architectural. Traditional memory chips they're kind of like sprawling suburbs of data. So to get data to the processor, it has to travel all the way across the motherboard. And for normal computing, that's fine. But AI requires processing mountains of data instantly. So HBM physically redesigns memory into like a skyscraper.
Oh, I see.
Yeah, it stacks the memory chips vertically right on top of each other and places them incredibly close to the processor.
Let me try to visualize that with an analogy for the listener. Think of training an AI model like trying to move millions of people from one city to another, right? NVIDIA, the chip designer everyone talks about, builds the ultimate sports car.
The fastest vehicle ever.
Exactly. The fastest data processing vehicle ever created. But if you try to drive 1 million of those sports cars down a single-lane dirt road, which is basically traditional memory,
Yeah.
you instantly have a catastrophic bottleneck.
Right, the traffic just stops.
Yeah, the speed of the processor doesn't even matter if the road can't handle the traffic. So HBM is essentially upgrading that dirt road to a 100-lane superhighway for AI data. And SK Hynix, they position themselves early to be the company paving that exact highway for NVIDIA.
And it's a highway they're building at breakneck speed. I mean, if you look back to 2019, HBM accounted for a microscopic 3% of SK Hynix's DRAM revenue.
Just 3%.
Just 3. It was a niche product.
Huh.
But by 2025, that figure is projected to jump to 42%.
That is insane.
That is $20.7 billion coming from a product that, barely registered on their balance sheet 5 years ago.
Meanwhile, Samsung is playing catch-up. Like, S&P projects their HBM sales will only make up 19% of their DRAM revenue by 2025. And Micron, the U.S. giant, they're pivoting too, but they're only forecast to be at 23%.
Right.
So SK Hynix essentially altered its entire corporate DNA to become an AI memory powerhouse.
They really did. And that corporate transformation is fascinating on its own, but, this doesn't happen in a vacuum. If we synthesize this with the bigger picture, the sheer volume of wealth being generated by that 100-lane superhighway has some profound implications when you zoom out and look at the host country.
Right, and that connects perfectly to the macroeconomic analysis from the Josen article.
Mm-hmm.
Because while SK Hynix is just printing money, the broader global environment is looking incredibly hostile. Like, the IMF is projecting average oil prices to hover in the $82 per barrel range this year.
Which is high.
Very high, heavily influenced by the geopolitical fallout and the Middle East war. And for an industrial powerhouse like South Korea, which has virtually zero domestic energy resources, that should be terrifying.
Oh, the math on their vulnerability is just staggering. South Korea imports about 1 billion barrels of crude oil.
1 billion.
1 billion. And 46 million tons of natural gas every single year. So when international bodies say oil is staying above $80, that price surge actively risks shrinking South Korea's annual trade balance by $20 billion.
Wow.
Yeah, that is roughly 30 trillion Korean won just vanishing simply because it costs more to keep their factories running.
And wait, didn't something exactly like this happen recently?
It did, yeah.
Like, I feel like we just saw the devastating impact of this exact vulnerability a couple of years ago.
You're thinking of 2022, right at the onset of the Russia-Ukraine war. Global oil prices spiked 58% in a matter of months, and South Korea's import costs shot up 13%, but their export prices only rose 7.4%.
Ouch.
Yeah, that mismatch just bled the country dry. It plunged them into a trade deficit for 15 consecutive months.
They were just hemorrhaging capital. So naturally, looking at the forecast today with $82 oil, you would expect alarm bells to be ringing across Seoul. But the Korea Institute of Finance Analysis reveals this incredible plot twist.
The aha moment.
Right. They forecast that despite this looming energy price shock, South Korea's trade balance will actually remain comfortably in surplus this year.
Because of the chips.
Entirely because of the chips. The sustained rise in semiconductor prices and export volumes, specifically that HBM boom we just talked about, is generating so much foreign capital that it acts as a macroscopic shock absorber.
It's incredible. SK Hynix and Samsung are quite literally insulating an entire nation's economy from global energy inflation.
And, when you lay out the fundamentals like that, a sector generating historic revenues backed by this unquenchable demand for AI, actively bulletproofing a national economy, it sounds like an incredible investment opportunity.
It definitely does.
But individual chip stocks are incredibly volatile. So I want to look at how everyday traders are actually trying to get a piece of this action. Here's where it gets really interesting, and this brings in that highly technical options breakdown from Tasty Live.
This is a crucial piece of the puzzle. Because traders see the macroeconomic strength, but they want to avoid the whiplash of picking a single stock that might drop $20 in an afternoon.
Right, nobody wants that stress.
Exactly. So they gravitate toward an exchange-traded fund. Specifically, the ticker EWY, that's the iShares MSCI South Korea ETS. It holds a basket of the country's heaviest hitters, providing direct exposure to that macro buffer we just discussed.
But heavily weighted towards Samsung and SK Hynix.
Exactly.
Now, the Tasty Live video outlines a highly specific strategy to trade this ETF, exploiting a current quirk in the market known as a call skew. And to strip away the jargon, a call skew just means that the market is heavily biased toward a boom. Options betting that the ETF's price will go up are significantly more expensive than options betting it will go down.
Right, everyone expects a rally.
Yeah, so the upside lottery tickets, so to speak, are priced at a premium.
And that premium is what allows for some very creative structuring. The specific trade mechanics they outline is called a call ratio spread, expiring in June, which was about 40 days out.
Let me walk the listener through the exact math of how this works, because it sounds like a magic trick. Okay, the EWY ETF is trading at roughly $180. A trader buys one call option at a strike price of $190.
Which is around a 40 delta.
Right. That means if the ETF goes above $190, the trader makes money. But buying that option costs capital. So here's how they pay for it. They sell TWO call options further out at a strike price of $205.
So they're selling twice as many contracts at a higher price target, around a 20 to 25 delta.
Yes. And because of that massive call skew, because the market is just overpaying for extreme upside bets, selling those two 205 options doesn't just cover the cost of the 190 option. By working the order down, it actually pays the trader a net credit of about 45 or 50 cents.
Just for entering the trade.
Right, which fundamentally alters the psychology of the investment. Because if you collect cash to enter the trade, you mathematically create a trade with zero downside risk.
It's wild.
Let's say oil goes to $150 a barrel tomorrow, or some massive geopolitical shock tanks the Asian markets, and the ETF crashes to 100. You lose nothing. You just keep the 50-cent credit. Now, if the ETF slowly grinds upward over the next month, you hit the meat of the trade. You can make up to $1,500 in added profit if the price lands perfectly between 190 and 205.
It sounds brilliantly engineered, honestly. You use an ETF to avoid volatility, you structure a ratio spread to avoid downside risk, and your underlying thesis is backed by a sector actively printing billions.
But I've got to play devil's advocate here. So the trader uses an ETF to avoid volatility, structures a trade to avoid downside risk, and banks on the strong fundamentals of Korean ships. Sounds perfectly safe, right?
Well, this raises an important question. Are ETFs actually the safe, stable vehicles we think they are, especially in emerging markets like South Korea?
And to be clear, the risk in that Tasty Live trade does exist. It just starts on the extreme upside at around 220, which is like a 25 to 30% upside move. But your question about ETFs themselves, that brings us to the twist.
The dark side of ETFs.
Exactly. The dense Federal Reserve paper on international capital flows, because everything we just discussed assumes that an ETF is a safe, rational reflection of the companies inside it.
And the findings in this Fed paper explicitly shatter that assumption. They studied EPFR data from 1997 all the way to 2017 to show how capital moves across borders. And their conclusion is that the explosive growth at ETFs is actually amplifying the global financial cycle in emerging markets.
Amplifying it, like making the swings far more violent.
Yes.
I really want to emphasize that because it goes against literally everything retail investors are taught about ETFs being the safe, boring way to invest.
The jaw-dropping stats here are sobering. The researchers found that ETF flows are astonishingly sensitive to global financial stress. We are talking 2.5 times higher for equity ETFs.
2.5 times.
Yeah, and 2.25 times higher for bond ETFs compared to traditional mutual funds.
To put that into a real-world example, the paper brings up the 2013 taper tantrum. For those who don't remember, this was a moment when the U.S. Federal Reserve merely hinted, they didn't even do it yet, they just hinted that they might scale back asset purchases.
Just a change in the tone.
Right. And global financial stress just spiked. Panic spread across trading floors, and investors withdrew $38 billion from emerging market funds.
And this is where the Fed's data gets fascinating. Because ETFs are so hypersensitive, they accounted for $11.5 billion of that total outflow. The paper calculates that if ETF investors had simply behaved like traditional mutual fund investors, the total outflow would have been $5.5 billion smaller.
Which is a huge chunk of change. So
Right.
wait, why are ETFs so much more skittish? Is it because they're passive or because they have really low fees?
You'd think so, but no. The Fed paper explicitly ruled those out. They controlled for passive management and fee structures. Yeah. The true culprit is liquidity.
Ah,
Because ETFs trade continuously all day, exactly like a stock, they attract a specific type of investor who values immediate liquidity over everything else.
okay, I have an analogy for this. It's kind of like having an eject button in your car. If you are driving and you hit a pothole, but you know your finger is resting on a bright red eject button, the second you feel a jolt, You're much more likely to press it. You shoot through the roof.
That's exactly it.
Right. Whereas a mutual fund investor, they're strapped in. They only price once a day at the close. They don't have the button, so they're forced to just grip the wheel and ride out the bump.
And that behavioral psychology leads to the ultimate irony connecting all our sources today. The Fed paper details how ETF investors in emerging markets are highly reactive to global push factors, like the VIX or U.S. monetary policy. But they are completely inattentive to local pull factors.
Like local industrial production.
Exactly. This means an investor panic selling the EWY ETF doesn't care that South Korea's macroeconomic trade balance is in a surplus. They don't care that SK Hynix is generating $20.7 billion in HBM revenue. The micro fundamentals are just completely ignored in favor of global macro panic.
Wow. So what does this all mean? Let's tie all of this together for the listener. We traced the physical reality of AI memory chips, essentially saving the South Korean economy from $82 oil inflation.
Real-world foundation.
Right. And then we saw how traders use ETFs like EWY to capitalize on this safely, only to discover that those very ETFs are injecting massive fundamentals ignoring volatility into the global financial system.
It's quite the loop.
It really is. And for you listening, the practical takeaway here is that the next time you hear about a fundamentally sound investment trend, like AI chips, or you look at a seemingly safe ETF trade, you have to remember who else is in that pool with you.
That's the most important part.
Yeah. You are swimming with traders who will hit the sell button at the very first sign of global stress, regardless of how good the underlying companies are doing.
The asset could be flawless, but the vehicle makes it vulnerable.
Exactly. Which leaves us with this final provocative thought to ponder. We always assume that making markets more liquid and easier to trade is a good thing for investors.
It's the whole point of modern finance.
Right, the modernization of finance. But if hyperliquidity causes us to completely ignore the real-world value of the assets we are trading, like the actual chips powering the AI revolution, is the modernization of finance actually making the global economy fundamentally less stable?
It really makes you wonder if the structure of the market is overriding the reality of the market.
It really does. Something to definitely think about the next time you look at your portfolio.